Welcome to our comprehensive video on insurable interest, a key concept in the insurance industry. By the end of this video, you'll have a thorough understanding of what insurable interest is, why it's important, and how it applies in real-life scenarios. Insurable interest is an essential principle in insurance law, requiring that an individual must have a financial stake in the subject of the insurance policy. For example, if you purchase a life insurance policy on your spouse, you must stand to lose financially or suffer some hardship upon their death for the policy to be valid. Just wanting to take out life insurance on someone isn't enough. This principle helps to prevent moral hazard where insurance could be used for gambling purposes rather than risk management. Now, let's delve deeper into the types of insurable interest. Insurable interest revolves mainly around three areas: property insurance, life insurance, and liability insurance. Let's break these down with examples. In property insurance, you have an insurable interest in your own home or any investment property you own. This means you would be directly affected financially if these properties were damaged or destroyed. Similarly, a landlord has an insurable interest in rental property because they would lose rental income or face repair costs in case of damage. Here's a question. Can you have an insurable interest in a borrowed car?
Yes.
You can. If you are responsible for the car while it is in your care, you have an insurable interest because you could be liable for any damages that occur during that time. In life insurance, the concept of insurable interest is crucial. A policyholder must expect to suffer a genuine loss in the event of the insured person's death. This is generally found in close relatives like spouses, parents, and children, or in business relationships like key person insurance. Consider a situation where a company purchases a key person insurance policy on its CEO. The CEO drives the company's vision and strategy, and their unexpected loss could have significant financial repercussions. The company, therefore, has a valid insurable interest in the CEO's life. In liability insurance, insurable interest exists when you are held legally liable to other people. For instance, a store owner has an insurable interest in having liability coverage for injury claims made by customers who might slip and fall on their premises. Let's look at some real data to understand cases involving insurable interest better. In Scenario 1, a homeowner had insurance which saved them $50,000 in repair costs. Scenario 2 highlights a business covering its key employee, avoiding $75,000 in losses. Scenario 3 involves a liability insurance case where a shop owner avoided $100,000 in legal expenses. Now, let's address some common questions. First, what happens if an insurable interest doesn't exist at the time of a claim? If there is no insurable interest at the time of the claim, the insurance policy is considered void and no payout will be made. This underscores the importance of ensuring insurable interest not only at the inception of the policy, but also at the time of the claim. Another question is, can insurable interest change over time?
Yes.
It can. For instance, if you sell a property, you no longer have insurable interest in it. Similarly, in life insurance, if a business relationship changes, the insurable interest may no longer exist for key person insurance. To summarize, understanding insurable interest is fundamental to securing an effective insurance policy. It ensures that policies serve their intended purpose of protection rather than being used for speculation. Always ensure that you have a legitimate insurable interest when taking out an insurance policy and keep it updated to reflect any changes in your circumstances. We hope this video has clarified the concept of insurable interest for you. Thank you for watching. Make sure to subscribe and hit the notification bell for more insightful videos on finance and insurance.